So I personally think everybody should strive to have multiple streams of income. The amount of money that's available and the opportunities to make that money are ridiculous. They're pretty much everywhere. One of my biggest financial goals that I gave myself in my 30s, something I mentioned in a previous video, is to have multiple sources of income, specifically sources of passive income. And one of those passive income sources that I have now, being dividend investing, is, in my opinion, the easiest form of passive income that anybody can obtain. You can literally download a brokerage app like Robinhood and start making passive income with dividend investing with as little as $1. So what are dividends? Let's take a look at a company like Apple. Apple probably has the highest market cap value of any company that exists in the world. They're one of the most, if not the most popular technology company with their iPhones, their iPads, their iWatch, pretty much anything with the letter I in front of it. That's what brings them a lot of money. And after they take that money and, for lack of better phrases, pay off their bills, they'll more than likely have a lot of money left over. Now, with a company, from my understanding, there's a few things they can do with that leftover money. They can either take that money and reinvest it into themselves, which is really beneficial to help grow the company if they want to put that money towards a new product or expand on their company, maybe build it in another country or another city or state. Or they can take part of that and do that, and take the rest of that and put that money back to the shareholders, the people that invest into their company, being Apple, for example. That money that goes to the shareholders is what we call a dividend. Now, a dividend is typically paid out from a company to a shareholder periodically. Most of the time it's quarterly, sometimes it's monthly, and I think I've even seen companies that pay them out annually. And there's really no catch when it comes to getting a dividend. It's more of a persuasive / thank you tactic from the company themselves. More persuasive because if they're giving you these dividends, not only do they want you to keep your money in their company as in continue to invest into them, but also invest more into them over time. And if you're like me, you think this is really cool because the more money you put into a company that pays dividends, the more dividends and the more passive income you get in return. I have my Robinhood portfolio, which is filled with pretty much all dividend paying stocks. And some of my three favorites include Apple, Verizon Wireless, and Realty Income. And the reasons why those three are some of my favorites have a lot to do with what I look into before I invest into a dividend paying stock. I'll preface this part of the video by saying I am not a financial advisor. I am not a professional dividend investor. I've been investing into stocks for about 4 years now, but these 4 steps that I take have helped me get into companies that pay me dividends over the long term. So hopefully they'll help you guys out. The first one is to check out the company's mission statement. Or what does the company do? This will give you an idea of the popularity of the company if you don't know already, the importance they have to whatever niche or just society as a general, and with all that information, how long could the company ultimately last? With that information, if you have the feeling that this company is going to last a long time, you not only have reassurance of the longevity of the company, but you also have reassurance of the longevity of the stock, and therefore the longevity of the dividend payout that they give to you periodically. To add to that reinsurance, the next thing I look at is their payout history. One of my favorite, if not my favorite, website to get dividend information on companies is dividend.com. Gives you a lot of information, including some that I'll mention in just a bit. But one of the things I really like checking out is their payout history. It actually shows you a little chart that gives you all the dates of when they paid that dividend, what that amount was, and then reminds you of how frequently they pay the dividends. So as long as you're not seeing any inconsistencies with payout, for example, if they pay every quarter but you notice they missed a quarter, and on top of that you actually see that not only they're paying consistently, but they're also increasing their dividend payout over time, then these are 2 really great things to show you that this company is reassured with longevity and they pay their dividends, and you may get a little bonus with more dividends. It overall gives you some confidence that the company is consistently profiting, which means you as an investor will be consistently profiting. The next thing I look at is the PO, or the payout ratio. The payout ratio is basically the amount of money that a company gives out to their shareholders in dividends in relation to the amount of money that they've taken in over that period of time, or their net income. Typically, you prefer the payout ratio not be so high, because if it is really high, then that means that instead of taking a little bit more money and reinvesting it back into the company to reassure you of their longevity and their growth, they're taking all that money and actually just giving it back to you in dividends. If they're continuously doing that, it would be that much more difficult for them to continue growing and to continue promising you that dividend at minimum, let alone increasing it. So for me, if there's a company with a PO ratio of maybe 40 to 50% or more, then especially depending on what the company does in their previous history, that will show me a lack of sustainability in not only their growth, but in this case, their dividend growth. So that's a company I typically would avoid. The other ratio I look at is the PE, or the price to earnings ratio. Now, this doesn't have anything directly to do with dividends in comparison to the PO ratio, but it does help me find healthy dividend paying companies. The PE ratio basically takes into account how much someone is willing to spend on a company's stock in relation to how much that company has actually made. I'll be honest with you guys when I say this, because I try to be as transparent as I can in these videos, because a lot of us are new. In the 4 years that I've been investing, it honestly took me the first year and a half to realize that the market cap, for example, Apple's market cap that you see on brokerage apps, which is basically their share price at that moment times the outstanding shares that they have available to be invested into, is not their actual net worth per se. Their market cap is based on what we believe the company will do in the future. That's why when we like a company, we buy more into them, or if we don't like it, we sell. And when we buy, the price goes up, and when we sell, the price goes down. So what a PE ratio does is it tells you how fine the line is between what the share price is on these brokerage apps and what the real share price is based off how much they brought in and how many shares they have available. Without really getting into the weeds of what the equation is behind it, which you can look up on websites like Investopedia.com, it gives you an idea of if the company is overvalued or undervalued. So for me, again, taking into account what type of company it is, if the PE ratio is over 40, I'm going to consider that company overvalued. And if it's under 40, then it could be either undervalued or just a growing company. Again, you want to look at the previous steps, including their mission statement, to see what they're all about. Speaking of sectors, another cool thing about the PE ratio is that it allows you to compare different companies in the same sector. So if they do the same thing and they have a similar share price and they currently pay a similar dividend, if one has a PE ratio of a little bit less than the other one, then that means that company may be better off to invest into because you're spending a lot less for hopefully the same thing as the other one. So with all that being said, now we can go back to some of those favorite dividend investing companies I talked about earlier. So the first company is Apple. I really love Apple, of course, because they're an extremely popular tech company, even though I use Samsung more than Apple, but whatever. So with them being so popular, they're invested into heavily, which shows a belief in this company over the long term. And that's really important when it comes to the dividend, because if you're wanting dividend stocks to be a part of your passive income stream, you don't want to have any type of position to where you're losing that passive income from any company. Speaking of their dividend, the payout is fairly low in relation to a lot of other companies, but again, they are a long-term company, so I'm not anticipating in losing that dividend at any point. Even through our pandemic, I was still getting paid dividends. The PE ratio is another cool thing to look at because again, you can compare companies in the same sector, and according to the tech sector, its PE ratio is just barely higher than the average, but it's 25. I'm not too concerned about that. So that pretty much means that people are willing to spend $25 for every dollar that Apple is worth. But in the sector, that's fairly average. And in the stock market in general, that's fairly low. So Apple is a pretty healthy stock for me to invest into, and it has been ever since. Realty Income is a real estate and investment trust, which basically just means you can invest into the real estate without actually going out and buying property. I really love investing into this dividend stock because for one, it pays monthly. Two, it's really consistent. So consistent that not only have they paid dividends to their shareholders over the past 28 years, they've actually increased their dividends over the past 28 years. Another thing that makes me really comfortable about investing into them is their overall mission statement. That's basically just what type of real estate are you purchasing. That ranges from retail stores like Dollar Tree and Dollar General to pharmacies, pretty much anything that's essential. Anything that's especially essential during, yet again, the recent pandemic. So even then, I was still consistently making these monthly dividends. One thing you want to keep in mind with a company that's a real estate investment trust, or REIT for short, is that if I'm correct, one of the qualifications for a company to be a REIT is that they have to pay something along the lines of 80% of their income to the shareholders in the form of a dividend. That means their payout ratio is going to be super high. I think their forward payout ratio, aka the prediction of what their payout ratio will be in the future, according to Dividend.com, is in the hundreds of percent. But this is the company's qualification, and they've been paying it consistently for me over the past 3 years. So that's another reason why I enjoy investing into that company. Verizon Wireless, on the other hand, is a bit of the outcast in comparison to these three because it's not much of a long-term growth stock, because I personally lost money over the past few years, but their dividend is the highest, at least on the recurring basis, and it's most consistent. I think they've paid their dividends consistently and been consistently increasing it maybe under 20 years, between 15 to 20 years. So for me, Verizon is a company that I strictly invest into, knowing that their dividends are going to be consistent because of the way they handle their funds, despite the fact that the company is consistently slowly declining over a period of time. That is a company I'm gonna keep looking into just to make sure nothing crazy happens, but again, consistent dividends. These are some of my favorite investing stocks to invest into in Robinhood. And if you download Robinhood right now, thanks to fractional sharing, you can start making passive income with dividend stocks for as little as $1. And of course, $1 doesn't sound like a lot, especially when you think about the output from that. When you invest $1 into a company, you're only gonna qualify for X amount percentage of that dividend. Quick example, if a company you're investing into is $10 a share, let's just say for now it stays at $10 a share, and they pay a 5% dividend, that means every year each shareholder is gonna get 50 cents. Now, if you invest $1 into it every single year, then you're only gonna get 10% of that 50 cents, which means you're gonna get 5 cents a year. That's not a lot at all. But imagine if you reinvest that 5 cents into the company every single year. So every single year you get just a little bit back. Also imagine that you don't invest $1 a year, you invest $2 a year, and then eventually $5 a year, whatever makes you comfortable based off your budgeting, your income, your bills, everything like that. Then on top of that, also imagine that the company starts to grow. Their stock price starts to grow because their productivity is going great. They're really popular with society. They're making major impacts. And with that, their dividend yield stays the same, that yield of 5%. So because of that, their actual payout starts growing even more. So now you're getting paid even more because their yield is growing. You're getting paid even more because you're investing more, and you're getting paid even more because you're reinvesting it back into that same company. It's a domino effect that takes a while, but if you stick with it, and that's just one company, you could make a lot of money with passive income in the form of dividend stocks over a grand period of time. Like for me, my first year, I made a little under $80 in dividend investing. My second year, I made about $140, almost $150. And right now, I'm pretty close to passing last year, and we're only in the month of September. So it takes a period of time, but you'll definitely get there. The combination of compound dividends and fractional sharing is the reason why I love using this form of passive income. But if you're looking for other forms of passive income or other forms of income in general, make sure you check out this video where I talk about some of the other forms of income that I've either done or I'm currently doing that I feel like are fairly easy for anyone to start. So let me know what you think about that. Hopefully you enjoyed this video. Leave comments below on what you think about dividend investing or anything in regards to dividend stocks. I do appreciate you guys watching, and until next time, as always, take care.